tearing it up. So I'm going to roll right into this, guys. I don't want to take a lot of your time. I just want to talk a little bit about what's happening in the market. If you watched or listened to or caught highlights from the Fed yesterday, the Fed meeting, they really, they kind of gave the impression a little bit that things were not as under control as, of course, the bond market would like. Everybody hopefully remembers the biggest enemy of the bond market is inflation. So then the reason the Fed was raising the Fed funds rate is to begin to stop the inflationary pressure or slow down the inflationary pressure. Of course, and I think I alluded to this a little bit yesterday at LO Academy. The Fed sucks. In general, the Fed is they're just a disaster. They tend to, try to manage the economy instead of using surgical approaches. They tend to manage the economy with a sledgehammer. And so most Fed watchers will probably agree that they're going to overraise the Fed funds rate. And instead of cooling off inflation, they're going to push us deeper into a recession. And it's almost inevitable. They just do. That's just what they do. But they kind of alluded to more increases, like maybe another 150 basis points, which would probably be two incremental increases, 275 base increases over the next year. But I do want you to see this little quick video, and I don't know if you're going to be able. I assume you can hear the sound. Can you hear this? Can you not hear the volume?
No.
Oh, well, that's useless. How the hell do I make it play on here? Oh well. All right. Well, never mind. We won't do that. I was gonna do. Well, here you go. I'm better. I'm cuter than Barry anyway.
You got to start the video. You didn't start the video.
Can you hear that?
No, we can't.
No.
Try pressing share sound in the bottom left.
Share sound where?
It should be in the bottom left of your window. Of the share selection window.
In the middle, maybe, as you'll get.
Oh, there it goes.
Projections from
All right,
Fannie.
well, let me start this over.
Start today because mortgage bonds, they've actually improved, if you can believe that. After a volatile session yesterday, they're now down 47 basis points, but that's a pretty big improvement from their worst levels. Kind of a similar pattern. I'll show you this to what happened back after the June 15th rate hike. I'm going to show you a couple of things in just a moment, but first, the Fed kind of surprised the markets with a few things. One was good. They said that they weren't going to be selling MBS anytime in the near future. Mortgage-backed security sales would be painful. Actually, mortgage bonds had a nice run-up on that yesterday, but they are indicating that they need to hike even more. Now, the sad part about it is that the Fed doesn't consider the fact that it takes time for these hikes to kick in. So they're probably going to overcook things like they always do to create boom and bust cycles. But the market took this as, wait a minute, that means the Fed's still behind the curve. They don't have a good handle on inflation. And unfortunately, we didn't get as good of a reaction yesterday in mortgage bonds. And today, we're seeing a pretty sour reaction. And Dan, could you fill us in on some of the other details?
Yeah, so when we take a look at their projections that they released yesterday, they increased by 100 basis points where they think the Fed funds rate is going to be at the end of this year. So that went to 4.4%, which means they're anticipating an additional 125 basis points of hikes. So it could be another 75 in November, maybe another 50 in December. And when you look at 2023, they're expecting it to be 4.6%. So off the cuff, it doesn't look like at first glance that they're anticipating maybe any cuts unless they hike a few times in 2023 and then start cutting from there. When you look at their inflation expectations, kind of pointing to what you said, Barry, not having control on the market, it looks like they're expecting core PCE, which remember they wanted 2%, to be elevated still at 4.5%. at the end of 2022. 2023, they expect that to come down to 3.1%, but still pretty high above their 2% target. And when you look at the unemployment rate, they're anticipating that to be 3.8% at the end of the year here, where it's currently at 3.7. But looking at 2023, they anticipate that to go to 4.4%. And when you couple that with the fact that they think GDP or growth in the U.S. is going to be pretty flat this year, revised from 1.7% and then 1.2% in 2023, well, it seems like the Fed may be thinking we could be headed towards a recession without outright saying it. In fact,
Hey, guys, just to point out really quick. So core PCE is an inflationary measure. Okay. It's one of it's the Fed's preferred way of measuring inflation. But when you look at them basically saying, hey, unemployment's going to go up almost a point and the GDP is going to stay flat. Those are pretty big, concerns about where's the economy and whether or not we're in a recession with two quarters consecutive of negative GDP growth, which is the legal definition or the financial definition of a recession. We're gonna see and feel recessionary pressures in the economy. So be aware, that this is the news that we're getting. So it's really important for our part to be more in tune to what's happening so that we can communicate to our clients and communicate to our peers that, what's happening in the economy. And some of what's going to happen in the economy is going to really be related to the Fed's overreaction. I believe them setting a target Fed funds rate of, it's 3 here. They're saying 4, 4.4, 4.6 in 2026. I'm sorry, 2023. That's what Barry just said was the Fed overcooking the economy, right? So what that means is they're going to make too many adjustments too strongly. They're not going to back off fast enough, and they're probably going to push us into a deeper
there was a
recession.
quote from Powell that said the chances of a soft landing are likely to diminish as the Fed continues to tighten. So as close of a middle maybe as you'll get. Now, we also got projections from Fannie Mae on their origination volumes for this year as well as next year. They're expecting it to be around 2.44 trillion and next year 2.2 trillion. So this is clearly about a 40% decline from the previous 2 years. And I know that's painful and you guys are certainly feeling that. But when you take a look at a longer time period, still a pretty good amount of origination volume as an absolute number. Although, of course, we have to keep in mind that home prices and loan amounts are much higher. So, to achieve that same amount of origination volume could be less transactions occurring. They also did say in their forecast that they expect there to be a recession in Q1 of 2023. And, Barry, you mentioned the Fed potentially overshooting things and not letting the Fed rate hikes actually catch up and impact the economy. Well, we're seeing that depicted in the inversion of the yield curve. It is now at negative 56 basis points, or at least it was yesterday. It's come back a little bit, and that's the deepest inversion since 1982. And we've shown you the pattern with this before, how that always translates to a recession, especially at an inversion like this.
We also got rental data from CoreLogic for the month of July, and year over year, they're still rising by 12.6% from 13.2% in the previous month. And although it's slowing a little bit, it's still extremely hot.
And today we got initial jobless claims and it came in relatively flat. It was actually up 5,000 to 213,000, but last week's number was revised lower by 5,000. So we're unchanged at 213,000. The 4-week moving average moved lower by 6,000 to 217,000. So all in all, really low numbers here. The labor market remains tight and we're still waiting for that recession indicating sustained uptick in filings for unemployment.
Thank you, Jake. Quick look at the charts, everybody. And you could see that we're down 50 basis points. It's not pretty, although there is a bit of an.
And this was earlier today. Obviously, right now, we're down 67 basis points. At the worst I saw of the day, we were down to 83. So we've bounced up a little bit, and but
improving from the lowest levels.
Bear's going to talk about the chart a little bit.
You can see this low level here acting as a potential floor. But let's go back a minute here to what we saw on June 15th. So here's when the Fed hiked rates. Now, remember, we closed here. Okay, that's where we closed June 15th. If you look at what happened on the open the next day, prices fell out of bed and went lower. So it was a dramatically lower open, but then throughout the day, slowly but surely, we started to see some improvement. Now, it's a very similar situation here, although we are down 64 basis points. It is quite possible that, especially with this floor here, that we could see a move towards improvement, kind of similar to what we had. The difference is, like we mentioned to you, the Fed seeming as if they are in less control of inflation, and the bond market hates inflation. What the bond market really wanted to hear was the Fed has a handle on inflation, and that over time, these hikes would definitely kick in and kill inflation, and they didn't want to go too far. So unfortunately, folks, we're in a position right now where the bond market just looks ugly. The 10-year looks ugly. But with this floor underfoot here, we're going to begin the day carefully floating. If we break underneath this floor here, we're going to quickly move to a locking stance. Have a great one.
So basically, and as you can kind of see now, this is the current. So you can see this wick coming out of the bottom of the candlestick. That was the lowest of the day. And we've moved up, obviously, but we are, we got a lot of loss here. So this little trend down, hopefully this line acts like a little bounce for us, this resistance line right here, and kind of protects us from staying underneath there, down in here. And maybe we'll get a little bounce. So if you take a look, this is what I'm looking for. Economic calendar. Coming up, the Fed is scheduled to speak tomorrow, the Fed chair. That's kind of important when he talks, because when he says stupid shit, he messes up our bond market. That's what happened he spoke on Wednesday, and you saw what happened today. So the Fed, if he says something that makes it sound like he's less bearish on inflation, right? Less concerned about inflation. If he says something that sounds reasonably favorable, we can all cross our fingers and hope. If he says something like that, then we may very well see, this thing bounce back up into this range up here. But for now, I don't think we're going to get a lot of improvement on today's market. I'm just hoping the floor holds. And I think we're going to start the day probably right around where we finished today, pending those comments at 2 p.m. from the Fed chair. So does everybody, you can unmute yourselves if you'd like. What questions do y'all have? Anybody, any questions about this, about charts, about the market, about what happened? Not all at once. About anything? Nothing. Okay. All right, guys. So that's, by the way, you've heard me mention MBS Highway or Barry Habib. That's what that is. You can get substantively the same information here on the on Mortgage News Daily. So you can see the trend is tentatively on the positive side, just because of the little bounce forward that we've had. And you can drop this back and you can kind of see the candlestick on the bottom. It's not quite as detailed, it's not quite as perfect, but it gives you an idea. This is a little articles and stuff like that. So if you're not tuned into Mortgage News Daily, I encourage you to set it as one of your bookmarks when you open your website, when you open your computer, have it pop open, Mortgage News Daily. And then during the day, click this MBS, which is mortgage-backed securities, current prices, more data, today's prices, and that'll bring you right to this chart. I usually would dial it back to 1 month or 3 months, something like that, just to kind of have an idea of the trend. And then you can watch and look. All of a sudden, it's moved a little bit here. So let's see what's happening in real time. This is delayed a little bit. This is real time. So yeah, it hasn't really moved, but we're just in this really ugly muck right here, unfortunately. And it's all because of Chairman Powell telling us that inflation may not be under control. And so you've heard me say it before, biggest enemy of the bond market is inflation. And that's a perfect evidence of the fact that bonds are dramatically impacted by inflation. Okay, so guys, if you have any questions, comments, whatever, please feel free to drop comments in the chat. It's definitely it's good to share our ideas. And Frenchie, thank you so much for being our marketing advocate and throwing out the ideas about what you're doing. Everybody should be listening to that and reading that and sharing. The other thing is, there's a lot of negative news out there right now. There's a lot of people out there talking about, oh, the sky is falling and we're all gonna, the market's gonna crash, right? And it's gonna be horrible. Well, it's also good to share your successes and your little victories and things like that. So let's kind of encourage each other, lift each other up, be each other's cheerleaders, and be involved. Okay, so have a great day. Thank you so much for dropping in, and I hope you guys finish the week strong. Make your phone calls, work your realtor target lists, and I promise you, activity gets results. So keep banging out the activity. All of your peers out there in the mortgage world who are wringing their hands and saying, oh my God, rates, I can't sell a 7% rate. Bullshit. In the last 50 years, according to Fannie Mae, in the last 50 years, the average mortgage rate has been 7%. So, we're still in the sixes for the most part. We may dip that back down into the fives before too much longer. So don't panic, okay? Everything will be all right. Peace. Have a great day. Thanks for being here, guys.
Thanks, Michael.
All right, guys, take care. Thank you.